Hello students, welcome back to Insightsias. In today's lazy lesson, we shall discuss about the government securities. So the reason behind picking up of this topic is that the RBI recently made an announcement according to which the non-residents can invest in selected government securities under the fully accessible route. So our focus today shall be on, firstly, what are government securities and why are they so much popular? Second, what are the selected government securities in which the non-residents are allowed to invest under fully accessible route? And thirdly, how does this move help the government securities find a perfect place in the global bond indices? So firstly, what are government securities, or more popularly called as the G-Secs? The first point to note here is that it is a tradable instrument. The second point to note here is that these securities can be issued both by the central as well as state governments, which means here both the central as well as state governments acknowledge the debt obligation. And the third point here is that the government securities can be both short as well as long term. Here, short-term government securities include Treasury Bills with original maturities of less than 1 year or 365 days, or long-term Treasury Bills include government bonds or dated securities with original maturity of 1 year or more. And the last important point to note here is that the central government here can issue both short as well as long-term government securities. This means the central government can issue both treasury bills as well as the government bonds or dated securities whenever it wants to raise money. However, this privilege here is not available to the state governments. They can raise the money only via the long-term route, which includes government bonds or dated securities. And these are called as the state development loans. I guess many of you are still confused about the government securities, their potential, their usage, and how do they operate. Well, in that case, let me make it more simpler. See, firstly we have the central government here. It needs money to run the country. Then, what are the main sources of revenue for the government? See, the revenue here can be from two sources. One is tax revenue, the other one is non-tax revenue. So, tax revenue includes personal income tax, corporation tax, and those charged under GST, that is goods and service tax. And non-tax revenue includes income from interest receipts, surplus profits of the Reserve Bank of India, income from railways, profits of public sector enterprises, etc. And sometimes even the revenue from both these sources is not sufficient for the government. It needs more and more money for new social sector schemes, new welfare schemes, new infrastructure projects, or even to face an unforeseen crisis such as the one we are undergoing through. So in all these cases, the government needs more money than it is actually earning. So it is precisely in such kind of circumstances the government resorts to selling off the government securities. So the working of these government securities is simple here. Firstly, we have the government here. It may be the central government or the state government. And then we have investors here. So what the government does is, it sells investor the government security, and in return the investor invests the promised amount. Say the government security here being offered is worth 5 million rupees. So after buying this instrument, the investor is transferring 5 million rupees to the center or the government. So now the government can utilize this money for whatever it needs. And in return, the central government would have mentioned the maturity date as well as the interest rate applicable on this government security. Say it is for a period of 24 months or 2 years. This means after the duration of 24 months, the government is paying back the principal amount, that is 5 million rupees to the investor. And in the meantime, it has already paid the interest amount applicable on this government security. So the benefit for the investor here is that after 24 months, he shall be getting both the principal amount as well as interests. And unlike other security instruments traded online, the investor has more confidence in government securities. Why? It is mainly backed by the government, which is a trusted entity. So in this way, both the central as well as state governments can offer the government securities. But the only difference here is that the center can offer both short-term as well as long-term government securities, whereas state governments can offer only long-term government securities, and these are called as state development loans. And here we have one significant difference between short-term government securities and long-term government securities. It is in terms of the interest payable. That is, the government does not pay any interest on T-bills or treasury bills, whereas it pays interest on the government dated securities. So please note this point. And please note that we have four main types of government securities issued in India as per the Reserve Bank of India. One is the treasury bills, second cash management bills, third the dated government securities, and fourth state development loans. So what are they? So firstly we have the treasury bills. They are money market instruments and are short-term debt instrument issued by who? Issued by the central government of India, and they are presently issued in three tenors, namely 91 day, 182 day and 364 day. And the unique feature of these treasury bills is that they are zero coupon securities, which means they pay no interest. However, they are issued at a discount rate. So what does this mean? See, the central government here is willing to raise rupees 100 for 91 days. So what it does is it sells this treasury bill, which is worth 100 rupees, to the investor at a discounted price, say 98.20 rupees. So the benefit for the investor here is that he is buying this 91 days treasury bill at a price of 98.2 rupees, but at the end of the 100th day he will be getting 100 rupees. So he has a net profit of 1.80 rupees. The 100 rupees is called as the face value of the treasury bill, and 98.20 rupees is called as the issue price of the treasury bill. And further we have the cash management bills introduced by the central government in 2010. Please note that even these are short-term instruments which are issued to meet the temporary mismatches in the cash flow of the government of India. They are similar to treasury bills, but the only difference is that they are issued for maturities less than 91 days. And similarly, we have the dated government securities which carry a fixed or floating interest rate. And here this interest is paid on the face value on half yearly basis. And the tenure of these securities range from 5 years to 40 years. And similarly, we also have the state development loans, which are one of the kinds of the dated securities. So please note here that the government securities are issued by the Reserve Bank of India. And next, the context for today's discussion is that the RBI recently decided to open the key government securities to full foreign investment by non-residents through the fully accessible route. There are two things to note here. Firstly, this intention was articulated in the Union Budget by the Union Finance Minister Nirmala Sitharaman. She had told that certain specified securities would be opened up fully to foreign investors. So, to operationalize this, the RBI has opened a new window called as the fully accessible route. And secondly, RBI has picked up few government securities, that is the 5-year, 10-year and 30-year bonds. So, non-residents are eligible for investment only in these bonds, that too from the financial year 2021. And further, the Reserve Bank of India shall notify the government securities that shall be eligible for investment under the fully accessible route. And please note that these specified securities will continue to be eligible for investment by even residents. The last point or last question we have is, one should invest in government securities, or what are the benefits of investing in government securities? See, first and foremost, besides providing a return in the form of coupons, these securities offer the maximum safety. Why? Because they carry the sovereign's commitment for payment of interest as well as the repayment of principal. So, there are less chances of defaulting. And secondly, they are available in a wide range of maturities ranging from 91 days to 40 years. And next, they can also be used as collateral to borrow funds in the repo market and can be easily sold in the secondary market to meet cash requirements. Moreover, securities such as state development loans and special securities such as oil bonds or Uday bonds provide attractive yields. So these are some of the benefits of the government securities. So based on today's discussion, try to solve this question, which is from prelims perspective. Which of the following are short-term government securities? 1. Treasury bills, 2. Cash management bills, 3. Dated securities. You can comment your answers in the comment section below. So that's it for today. If you enjoyed watching this video, please do subscribe and like this video.